you can't really be a valuable advisor to a company unless you've lived in their shoes for a while. And so we really try at the very beginning of every investment to really get involved. If it's customer interactions, it's definitely knowing every member of the team you're hiring, making sure that there's a good fit there. And, we spend a bunch of time at the beginning really just getting involved in those companies.
Hello, and welcome to Shopify Masters, the podcast powered by Shopify, your companion for starting and building a business. I'm your host, Adam Levinter. So picture this. You have a brilliant product, a tight business plan, and a great strategy. Perhaps you're already in market and scaling up, yet you don't have enough capital to fund the next phase of growth. Joining me today is Robin Axon, general partner at Mantella Venture Partners, a venture firm with a phenomenal track record, including being a very early stage investor in QuickPlay Media, Ritual, Shoppe AI, and others. Robin is here to chat with me about all things venture capital and entrepreneurship. Robin, thanks so much for joining me.
Oh, thanks for having me. Nice to see you again, Adam.
Yeah, you too. So there's a lot going on in 2022. We've got rising interest rates, rapid inflation, supply chain woes, markets in general are down. All these things are impacting what's happening in the world of venture, of course. Give us a state of play, Robin, in early stage venture this year and where you expect things to head in Q4 and beyond.
Yeah, I mean, it is a question that I'm hearing at every board meeting and every company considering raising money. And I think we all know coming into 2022, when the markets crashed, the advice that was going around the board was, if you can cut burn, if you can lengthen runway, do not plan to raise money in 2022, 2023. I mean, I think that advice still really holds. Everyone's focused on trying to build or get to profitability, reduce dependency on venture money. And I think that really does hold. But, the one thing that I would say is I'm one of the old guys in venture now, and this has been going on. These cycles come and go. And, I think these kinds of corrections that force you to take your foot off or your eye off growth and a little bit more on business fundamentals is a good thing. And that's kind of what's happening. So ultimately, good companies will get funded and companies with the right fundamentals will get funded. And it's not just about growth anymore.
How are you guys resetting? Like, are you coming up with some different criteria in terms of what you deem attractive in a potential investment versus, say, where you were last year?
It's interesting. We aren't as comfortable as a fund. We're a small fund. We're very hands-on. We like to really get involved with the entrepreneurs. And one of the fundamental tenets of our investment thesis is that we can support a business to a level of profitability. We generally don't like to invest in the kinds of companies that require tens or hundreds of millions of dollars to get to a point where they can be sustainable. We like to build things that we could, if we had to, if no other investor was interested, we could support the business. So in this kind of environment, this is exactly what we do. We were built for this environment. In fact, my partner and I have talked about this a bit. The past 2 or 3 years, or maybe even longer, you could argue, has been a really unusual time with crazy high valuations. You sometimes wonder what you're doing wrong. This correction sort of shows us, we did the right thing by sticking to what we're good at.
Do you feel like you guys will be okay sitting on the sidelines and not making investments, say, for the foreseeable future, the next 12 months or so?
No, we've actually had our most active year of investing since the formation of Mantella Venture Partners this year. We have never seen better companies. The kinds of founders, remember, we're very early stage. We meet founders when there's a founder and a concept and a category, and it's very early, but the kinds of founders that are willing to start companies in this environment are our kind of founders. Tenacious, they really have a passionate interest in the category or the product they're trying to build, and so for us, we're seeing a very, very active period coming over the next continued 12 months.
I had this tabled for later on in the conversation, but you bring it up. So, what makes someone a good founder? What are the qualities and characteristics that you believe founders need to have in order to be successful?
Yeah. No, look, it's everything. If we're as early as I say we are, which we have been in most of our investments, we only have the founder to evaluate, and maybe a category to go in. So we've spent the past, 10 or 12 years working on a founder scorecard where we really focus on, the history of the founder, the attributes of the founder, what you can get out of reference checks, even just the early beginnings of the company. But I'd say to you, like, if we had to really, and in our scorecard, sometimes is 10 criteria, sometimes it's 7, it's 8. We kind of go back and forth on this all the time and try to evolve it. But, fundamentally, it's really about the ability to grow and learn and listen, to be mentored. If you have a founder that's going to grow as fast as the business is, it's going to be fantastic. And I think the second thing that's really important is that tenaciousness in a founder, that the founder is not going to give up. And we've got some other things we look for that I think, depending on how mature the state of that business is, or how many companies the founder has built. But if you combine those two things, I think you have really the perfect kind of founder for our portfolio.
Do you look specifically at tenacity relative to previous businesses or track record in business, or do you find that you come across, say, first-time founders that have this?
Great question. I think the hard part here is you don't always have another portfolio or a company that the founder has built. You look for it in their lives. You look for it in things they've done. The program they chose at university and why and what they did with it and how far they took it. Did they have any little seedlings of startups? Did they sell T-shirts during university? What caused them to quit that? You look for the transition points between where they were in their lives and what were the little things that tipped them off what they were aiming to do, and or do they have a history of seeing everything through? So, it's great if you have a successfully built portfolio company in their past, but that's often not the case.
So, Robin, in your personal opinion then, what makes someone a good founder? What are some of the qualities and characteristics that you believe founders should have in order to be successful?
So, if it's an early stage company and there's no traditional kind of venture money in there, I always recommend angels that understand the domain or the category or the kind of company you're building. You always want to add someone to your business that's going to add value to it. Someone that will understand it, someone that, when things don't go as planned, they get it, that they've been there before. And I think that actually that advice holds throughout all levels. But, when you get into, moving beyond your $1 million check and you want to raise a $5 to $10 million round, a venture investor that has made investments in a similar kind of company is going to be there, is going to show that they can be there through the good and the bad times. Every company is going to go through bad days. It always does. There's always a hiccup. There's always something terrible that happens or that makes you look like you're not going to make it through the finish line. A VC that's been there before in those kinds of companies is not only going to be helpful, they're going to be aligned in understanding. So that's, when we invest in the very, very early stages of companies. So we're there for the discussion of what kind of other additional capital do we want to bring on and who do we choose? Is it about the highest valuation or is it the best alignment and fit and support? And we always choose the latter.
What industries do you guys typically invest in? And as a second part to this question, can you share some of the key metrics, ratios, KPIs that you guys look for?
Yeah, so at a very, very broad, top of the funnel kind of discussion, we invest in software. Software is where you can build, very, very efficiently, $500,000 to $1 million early investment can get you pretty far. It can get you customers, can get you some repeatability in the sales funnel. And so inside of that question, it's whether or not we're looking for, you've got consumer or B2B, you've got vertical market software. And honestly, I think the only one that I would say is tricky, and we've made a few investments, Ritual, Felix, and Rome in the category of direct to consumer, but we're often a lot more cautious, higher bar when it comes to consumer, because inevitably they come with a requirement for raising cash for marketing and require a little bit more capital. But if the founders are outstanding, then we'll spend a little bit more time there. And then, when it comes to our the operating metrics we look at the time, a lot of times we don't have them. A lot of times we will spend the time with the founder talking to early customers, really trying to understand the market, because a lot of time there isn't anything there yet. It's trying to validate the basic elements of the business, the acquisition costs of customers relative to the value of customers over time, and how will that look when it starts to scale. And it's really, really basic things when you look at it that way, and they obviously break down into cohorts and more complicated analyses, but that's usually stuff we're doing with the founders as we're preparing to raise additional capital after our round.
Mm-hmm. So let's go back a little bit because we got to talk about your background. It's so interesting. We've seen some interesting career pivots, but I don't think we've come across yours yet. So how does one go from aerospace engineering into venture?
Yeah, I appreciate that. And I have to admit, my father was not incredibly happy that transition. He liked having a rocket scientist son for a while there. My transition's pretty simple. I wanted to be an entrepreneur. I realized after I got a job and I worked at the Canadian Space Agency that it really wasn't for me long term. There wasn't enough innovation and people interactions in it for me. And I started to explore the idea of becoming an entrepreneur and did an MBA and met a bunch of people along the way, CEOs, company builders, things like that. And I decided I wanted to be an entrepreneur. And along the way of doing that, I put a pitch deck together, a 27-year-old version of myself out there saying I'm going to take on the world, and here's the big company I'm going to build. And the feedback was pretty consistent. Hey, you're a smart guy. This sounds really interesting, but you're too young and you've never built a company before. So I ultimately took a job with a venture fund that I was pitching the idea to, as opposed to raising money from them. And I remember going to, it was an interview at a open house party for the venture fund. And so I got to meet all the CEOs, then the portfolio companies. And one of the CEOs said to me, do it. Take this job. I know you want to be an entrepreneur. That sounds good. But imagine you can learn from the dark side for 3 or 4 years. But then when you go back out to raise money and build your company, you'll have understood both sides of the coin. So I planned that and never actually escaped.
So still here. You know what? Before we talk further about this this career path, I find it interesting that there's not enough innovation in the world of space. That you decided to take a leap over into the world of just sort of building companies and general entrepreneurship.
Yeah, and honestly, it's a little fair and a little unfair. Like, at one point would be that, the computing technology they use in the space station is way behind what we're using today on our phones in our houses and things like that. And there's some incredible innovation in hardware and camera and detection and automation in space that allow all these things to happen safely. It is an amazing area. And if I'm really honest about it, it was really working in the space industry during the 1997, 98, 99 boom of technologies where everything in the world felt more exciting than what I was doing. Really is what happened. And it was just really tricky for me to sit there and imagine, the next space station arm project, which won't launch for 5 years. Let's spend our time building, manuals and operating procedures for this awesome new technology, but it's a 5-year away thing. Meanwhile, eBay had just been built and had grown to, $1 billion company in next to no time. And so I was probably drawn out more than I was pushed out of that industry.
Mm-hmm. I'm chatting with Robin Axon, general partner at Mantella Venture Partners. Robin, what is the origin story of Mantella Ventures, and how do you and Duncan become general partners there?
Yeah, the origin story is it's got a couple of little bumps, so I'll make sure I hit them. But Duncan was an entrepreneur in residence at a venture fund that I worked at. It was my first venture fund that I worked at starting in 2001. And Duncan had sold his company to IBM and joined as an entrepreneur in residence. And we spent a lot of time working on the investments we'd all made together. And so we sort of planned from early on that we were definitely going to do something together. Ventures West made a call after their 8th fund, that was the fund that I was at, to not raise an additional fund. And so there really wasn't the path forward was gone. I had been made partner there. I had amazing mentors and experiences by working there, learned a ton. And so we went off on our own without a real plan. And we stumbled into 2 amazing entrepreneurs, Ray Reddy, who was the CEO and founder of Ritual, and Chris Sikornik, who was building Disco now, but is also in our portfolio, was building Chango then.
Right.
Yeah. And so we just spent every day. We joined in an office together, and we spent every day building those their first two companies, which were Push Life and Chango. Now they're Ritual and Disco, and loving every minute of actually getting into operations. Business development, sales calls, ops, hiring, firing. It was an amazing experience. And out of that, we got a phone call one day from a group representing someone that wanted to build up a venture fund, wanted to be a partner financially, but wanted to build something up. And it was really aligned with what we were trying to do, which was really hands-on, really about upside, not making money on salaries, but really if we could build something great, we'd all do well. And so we partnered with the Mantella Corporation to build Mantella Venture Partners. And that was 2009.
And 13 years later, you guys have a killer track record. I mean, folks in the Toronto startup scene, in venture more specifically, they speak to the quiet yet very impressive track record of this company and this portfolio that you guys have built. So congratulations. If we were to think about your key differentiators as a VC, I know you mentioned hands-on support. What are some of the other differentiators that Mantella peddles, and what does hands-on support actually mean from a founder perspective? What should they expect?
I mean, look, at the end of the day, we do have the luxury of being a lot older than we were when we were starting this out, and we have a lot of experiences. There's been a lot. Duncan founded his own company early on and sold it and went through the trials and tribulations of that, and now we've done that with a lot of different companies. But I would say, on a working basis, what it generally looks like is we don't spend our time trying to contribute at a board level. We try to get involved in, maybe if it's a really early company, a weekly ops meeting where we help set that up and structure the plan for the year and how we measure it and how we monitor it. And, it's something that Duncan and I believe very strongly in. We learned a long time ago, and that is that you can't really be a valuable advisor to a company unless you've lived in their shoes for a while. And so we really try at the very beginning of every investment to really get involved. If it's customer interactions, it's definitely knowing every member of the team you're hiring, making sure that there's a good fit there. And, we spend a bunch of time at the beginning really just getting involved in those companies. So if a debate comes up, I don't need a 15-minute background discussion on what the debate is. I should know. I'm in there. And I should have enough context to add a lot of value. And every once in a while you get the privilege of being 8 years into a company like Ritual where you're still valuable. And one of the reasons is because you've spent so much time at the beginning of the formation of the business to really understand where it came from.
We're chatting with Robin Axon, general partner at Mantella Ventures. So Robin, correct me if I'm wrong, but before the pandemic, one of the attractive things about Mantella is that after you would make a portfolio investment, you'd actually have these companies physically sit in your office. So all of your portfolio companies were physically in that same space. So now that we are beyond COVID, is this still the setup?
Yeah. I mean, look, if you had talked to me 13 years ago and said, hey, how is this going to work? It's not going to scale. I would have said, that's a really good point. Thanks for pointing that out to me. But somehow we've made it work. We are on Wellington Street here in an old, brick and beam building. And when we make an investment, we throw out the offer to the company, and I'd say 90+% of the companies have come in, hired and grown here, and then, evolved beyond us and moved out here as soon as there was way too many people for the space. But yeah, we're still here. We have two companies in the office with us. There's a little bit of remote work happening, but basically throughout this summer and beyond, everybody's been in. But there's two companies here, and one of them is actually just exceeding the size limitation and moving out in October, and then we'll do it all over again.
I imagine there's also value in having these companies interact with one another in terms of where they are on the business lifecycle side of things. Is that a value add?
Yeah, and we sort of look at it as the Mantella family, and the number of times a CEO of one company is either co-invested or helped hire or given advice to someone at different stages of their business. It is a really, really important part of what we enjoying what we have and helping grow what we have. And for example, we often try to throw a collective office get together on a Thursday night. Maybe it's once every 2 months, 3 months, 4 months, but it's pretty neat to know we're doing one this coming Thursday, ironically, and I think there'll be representation from 7 or 8 of the different companies all coming in, and one of the benefits is you're an 8-person company, and a Thursday beer night or social night on with 8 people is not that exciting, but when it becomes 72 people, it's pretty neat. You feel like you're at the center of something a lot bigger than you currently can take credit for.
Totally. I know there's a lot of folks listening that are probably thinking about raising, even though it might not be, as you say, the right time to raise capital. But notwithstanding that, what can you share in terms of valuations and how multiples have been impacted? Let's just use SaaS as an example. Let's look back at, say, 2021. Where are we now, 3/4 of the way through 2022? And what do you think? How do you think founders should reset expectations in that regard?
Yeah, valuations have definitely come down. And I think the bigger you are as a company, the more evident it is. When you have a $10 million run rate and you might have been expecting several $100 million valuation or way higher than that, they've definitely come down. And that is definitely sort of more mark to market, where you look at the public markets and you can see the comparisons, and they've dragged everything down. Early stage venture is still, seed stage, pre-seed. It really does. If you come to the table with a repeat founding team, you're still going to get benefited in valuation wise. It's still hard to find those. They're still very rare. And if you're a first time founder, no track record, maybe even no team, valuations never really went up and never really came down. They are going to be what they are, and honestly, the question is about expectations, but honestly, I always try to move people's expectations off valuation and more on the value of the investors you're bringing to the table when you're putting a round together.
Yeah, I think that makes total sense.
I would rather you look at the option that says, here's someone who understands my business, is going to add a ton of value to it versus the person paying the most.
Sometimes I find, at least in my experience, that a lot of founders don't know whether or not their business is a venture-worthy type of business, right? They're sort of thinking about venture capital, but maybe not understanding that actually going that VC equity route is not as attractive as, say, bootstrapping or using debt as a vehicle for growth. So what do you think the right profile of a potentially VC-backed SaaS company would look like? Or even a D2C company, let's say. When should founders start thinking about VC money versus, say, the alternatives?
This was one of the premises in founding Mantella Venture Partners, was that, throwing $5 to $10 million Series A at any company leaves these companies in a really bad spot when they find out later they're not really the venture kind of growth story that they need to be. And they've got this giant liquidation pool they have to pay back. And if they build a $19 million company, then everybody's unhappy. And honestly, it really does come down to alignment of the size of company you think you can build. And my view on that is you don't always know that day one. There's certain businesses that are going all or nothing into major categories, but there's other businesses that you don't know that yet. And so we always suggest waiting in. Look for $1 million reasonably sized angel round and really try to prove that you're worthy of raising a $5 to $10 million seed or A, or whatever you want to call the next category then. And and take it like stepping stones across the river. You're not trying to make it all go in one jump. Once you're on stepping stone 1, the visibility across the river is increased. You can see more of where this company can go and how big it can be, and you can make those decisions then, as opposed to all at once at the beginning, where you're left with no choice but to build a 10x return company, which is what every venture fund is looking for, or 10x plus, or nothing. And so those are the kinds of companies that have no options, that continue to try to grow unreasonably fast because otherwise there's nothing useful for their investors.
No, I think a lot of it is just getting real about the pressures of building a company when you do have a big round backing you. Thanks for sharing that color. Robin, you've had amazing success with Mantella. You've served on several boards. You've been behind some great technology companies. What has been the most difficult lesson that you've learned along the way? Something unexpected.
I think a couple, just in the theme of what you're talking about, is definitely, you look at the options, you look at raising money, and you look at making these decisions as a company and valuation and growing. I think one of the things that you don't realize is that if you ever have to step back off of some of these decisions, let's say you raise money at a $50 million valuation and you're growing, and then you realize, whoa, this is not sustainable. We have to step back. We have to maybe raise at a down round. Something has to be, we have to lay a few people off in our company because our burn is too high. These things seem on paper like they're really easy to do, and they are incredibly difficult. In many cases, they kill the company. It's not necessarily immediately, maybe 6 months later, maybe a year later. And we're going through a time right now where everybody is considering layoffs. Everybody is dealing with down rounds across the board. And it is a really tricky time. And it will be interesting to see which companies can manage through it. This kind of environment takes a lot of companies down. And I think it's honestly if I were to take the CEOs in our portfolio and ask what's the worst thing that they've ever had to go through in any part of building their business, everyone would say something around a layoff or a down round, meaning you've got not so much that the valuation went down, but you now have a whole bunch of people that maybe aren't as motivated to keep building the company. So it's these negative forces that you got to deal with. And definitely layoffs and down rounds are the worst.
Mm-hmm. But we are seemingly heading into that type of environment, that sort of recessionary environment. Assuming we are in a pseudo recessionary environment, we'll probably have a lot of this. For those that don't really understand the mechanics of a down round and how that might kill the company, could we just double click on that? Explain how this works in practice and how this could really kill a company, as you say.
Yeah, I think like there's a couple parts of it. One is your entire employee base, your team. You've been handing them stock options, presumably. In all of our company cases, stock options is a big part of why you might choose to join a company. And the stock options come with a strike price, the price that option is worth. And if the valuation of the business starts to drop such that the stock options no longer have any value to the employee, they're going to look beyond that. They're going to say, look, why have I taken maybe a slightly below market salary, or I've spent 80 hours a week with this company? Why would I do that if the extra piece that I was doing it for, that extra reward, is not there? The other one that I think is a really big part of it is once you've had your valuation come down, it can happen in a couple of ways. One, it might be an inside group of investors. Everyone that's still there decides to raise money at a lower valuation, and they put more money in the company and they agree on the new terms. Or it might be set from someone on the outside. And now you're stuck in this position where your valuation is down. It may be harder to attract new investors. You may not be able to attract new investors. You may just be dealing with your inside group. And now you've maybe pulled the last of the money out of that inside group into this company. Everyone has a limited commitment to each investment. And if you pull it out in this sort of saving round, the down round, you may not have any other options left to go outside other than if I'm looking at a company and it's my very first look at a company, assume I'm making a late stage investment, I'm going to compare it to everything around me. And if this is a company that's struggling and failing and has huge liquidation pool of capital, I'm either going to say we need to really correct the situation, or it's going to have to be a really low valuation to go forward. So it just gets harder and harder to fund that company from the outside.
Assuming these stock options greatly impact company morale, right? What is the role now of the founder in not only resetting expectations and coming to terms with reality on the ground, but going back to their employee base and motivating everybody again? Like, what are you seeing work in terms of founders kind of rallying their troops and getting their employees to stick around versus, say, leaving for some other option?
Yeah, I mean, I think it's the what is what you said. How do you remotivate, and the how is the hard part. And that's an individual character trait. There are certain founders that are just amazing at resetting. Hey, here's the reality. Here's the new story. They lay out another vision, even though it's on a past failed vision potentially. or just even a bad environment. And they say, here's the new vision. Let's get excited, rah, rah, rah. And they can get people excited again, even a second or a third time. You've got the Steve Jobs type founders out there that have done it over and over and over, even in the face of bankruptcy, even in the face of a failed company and a new company on the other side. It really is a trait of a founder that you need to have if you want to survive these times.
I'm chatting with Robin Axon, general partner at Mantella. Robin, before we go, I was intrigued to see that you founded the Young Venture Capitalist community at CVCA. Where does your inspiration for helping younger entrepreneurs come from?
Back in 2001, I joined Venture Capital, joined Ventures West, and there were not a lot of younger members in the venture community. I think that it was a time where people were starting to. It's a young industry in Canada, and I started this group called the Young Venture Capitalists, the YVC. Funded it out of my fund's bank account. Raised money for a golf tournament, had a golf tournament, had another at a dinner and things like that. So all of the people that were, the young associates had a place to meet each other in a environment that was a little bit more friendly than the big CVCA kind of conferences, and it took off, and it's been really successful. And kudos to the CVCA. The CVCA came along about 2 or 3 years in and said, "We love what you did. Let's bring this in and branch this into the larger organization, the industry organization is called the Canadian Venture Capital Association." They brought it in, nurtured it, supported it, made it about 10 times bigger than it was. I'm really proud of that. I'm really proud of what they've done with it. It's become something really great, and it still persists. But your question was about where did it come from? I think the working with entrepreneurs and the advising and what I do in my day-to-day life, which is what I love, I've always found that I've been innately interested in business. I love every aspect of business. I love learning about it. I love all the new challenges. Every new company we go into is different. There is no playbook that works for every company. It's so amazing. I love business, but I was nurtured by two great teachers that love teaching, and I definitely have a bit of that in my body, where it's about working with people and helping make other people great, and helping watch other people learn, and finding those people that are the most open to learning. And if you look at it, for me, it's the perfect mix of what I was meant to do.
Awesome. Robin, thanks so much for the time. Thanks for the color. Appreciate you being here. That's Robin Axon from Mantella Venture Partners. I'm Adam Levinter. I'll catch you next time on Shopify Masters.